Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Last week, we had the crucial non-farm payroll number, which beat expectations. A higher figure is good as it shows more employment in the non-agricultural sectors. Yet, we saw a good amount of dollar volatility ending with slight dollar weakness. Key is in the details. The shift will now focus towards inflation data. We have many this week, including that from US, China, Japan, and India. Good morning, JK. Your interpretation of the non-farm payroll numbers and what themes you think would drive the markets this week?
Good morning, Swaraj. Yes, I think we had the most important, macro number in the very first week, and that's the non-farm payroll number. As you mentioned, we had a fair bit of volatility in the US session on all markets, rather. So the non-farm payroll number headline was good. 216,000 jobs created, unemployment rate coming down, and then also the wages inflation being higher. But the details show that there were 26,000 of revision down in the October number and 45,000 revision down in November number, and that put off the market. So the initial knee-jerk reaction of bonds being sold off and dollar being bought was kind of reversed later. And yeah, of course, wage inflation was higher, but then overall, if you see the bond yields, because they had moved down so much in the last month, and the reaction was very much justified. But what eventually turned the market decisively up, rather down for the dollar, and also neutral for the bonds, is the ISM services report, which showed services sector slowing considerably in December. The index came at 50.6 versus 52.7 in November, while market was expecting 52.6. Now, important part of the report was that export order growth slowed considerably. Services inflation somewhat elevated, but but the measure of services sector employment plunged to 43.3 last month, the lowest level since July 2020. That was, in the times of pandemic. So that was something that the market took note of, and then again saw renewed selling in the dollar, euro, GBP, and yen, all of them making very good gains of over 1% after these numbers. So if you look at the other data, that day we also had the German retail sales that showed again very strong, a very big fall rather of 2.5%. Versus 1.1% that was seen in October. So the 2.5% fall was in November, and economists had forecast sales to fall just by 0.1%, and on year also it was 2.4% lower. These numbers actually do increase the belief that Eurozone may be in for a technical recession. Fourth quarter GDP might show a negative. Third quarter GDP was already negative 0.1%. So Germany is definitely the leading from the front in this slowdown in the economy. We also had the Eurozone flash inflation data. That a headline jumped to 2.9% from 2.4%. But again, this was because the government withdrew a lot of subsidies that was given for the items whose prices had gone up substantially. So the base effect was the responsible, and we really need to look at the January data to confirm whether inflation has based out or it has still some fall to do. The services PMI in both the Eurozone and UK painted a good picture. Now, if you look at the bond yields, they moved wildly before and after the US data, taking cues from the Eurozone inflation, of course, before the US data, and then after that, slumping when the German retail sales came. And then yields also rose immediately after the jobs data, but again fell after the ISM. But overall, yields have moved up quite a bit. In the week, twos have moved about 24 basis point, tens around 30 basis points, and the 30s also around 22. 10s and 30s have moved actually to 22 basis points, and these are quite a bit of rise from the lows of December. And this is even disregarding the wild run of data during the week. Yields have been on rise, but I wouldn't put this as a major reversal in the view of the market on interest rates, although expectation for March hike have come down to around 62% from 85% that was seen at the peak. But this is just a position, position adjustments, because market had gone too long on the bonds, and then of course the rate hikes also. There is not much of a change. It's still showing 1.5% rate cuts, rather rate cuts by the Fed in this year. So that was a very volatile period as far as bonds were concerned, and then equities were kind of subdued, and of course they did have a good fall over the week, and that got halted somewhat now, because we also face the earnings season starting this week. The investors would be wanting to see how how the companies have performed in the face of higher interest rates, and if they are maintaining their growth, I think that may be some positive for the stock market. Currencies were volatile. Dollar was rising during European time based on the German retail sales, and technical selling in the euro and GBP. But non-farm payroll, subsequent reaction after the non-farm payroll based on the revisions to previous month's number, as well as ISM services number slumping big time. These helped the dollar to fall, and so the euro went almost to 1.0990, and GBP above 1.2750. Dollar yen, in fact, also from almost 146, it slumped to 144 during the US session. All of them ended with still with good gains for the day from their lows, and so I do see a bit of underlying softness in the dollar, because the reaction to negative news from US is much more than reaction upside of the dollar for any positive news. So although we do require some consolidation in the currencies before we can see them move to the next level. So wait for some consolidation, particularly as we have the CPI inflation number from US on Thursday this week. So till then, maybe some consolidation is what I'm expecting. On the Chinese Yuan, of course, there was a weakness which was towards 7.18 levels, almost 1.1% weakness from the lows seen in December. But again, state-run banks in China were very actively selling in onshore and offshore markets. And they were also tightening the liquidity availability so that the Chinese Yuan is not under fresh attack from the speculators. So Chinese Yuan also saw a fair bit of volatility during the session on Friday. As for the rupee is concerned, as I've been mentioning, we are seeing a bit of a resilience in the rupee, and more towards the downside of the dollar, with lesser intensity of intervention from RBI. We are seeing some flows, but they're not as big as what we had seen in December. Of course, there is expectation that flows will be higher going forward. But currently, we are drifting down as far as the USD-INR is concerned on a very gradual basis. So, 83.10 will be the first barrier to break for the USD-INR, and then after that 82.90 is a very crucial level, which has not broken for a few months now, and a break and close below that can be very positive for the INR to post some more gains. Yeah, I think the first week of the year has started with a fair bit of volatility, but no clear direction as such, and some semblance of strength in the INR. This is how we should summarize. Have a good week. Thank you.
Thank you, JK. And quickly summarizing, the non-farm payroll data on Friday was a good headline number, but including the unemployment rate coming down, wage inflation higher, but details show revision a revision down for previous numbers, which was not taken up well by the markets. Services sector in the US is struggling. It showed slowdown, and it had the employment also in the services sector has come down considerably, hitting 2020 levels. We had German retail sales showing big fall in November, falling 2.5% against 0.5% fall expected. Now markets may be thinking that eurozone is maybe in a technical recession, and of course all of this intensifies the fight of who will cut first, eurozone or the Fed. um, when it comes to rupee, we have a strengthening. There is a rupee strong bias with lesser intensity of intervention by the RBI. So 83.10 and then 82.90. These are two crucial levels to watch out for. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.